Hello and welcome to Dividends and Investing with Auditor Dan. So this is a follow-on video to cover another Hartford study other than the one I did about dividends. So this one is a topic about timing the market. So to make it clear, like you're going to say, well, why aren't you an index investor? Okay, so the most important thing as a retail investor is to just keep buying, right? The most important thing is just to keep buying. You don't get out of the markets. You keep investing over long periods of time. You will have the compounding appreciation of the market. So you have index investing teaches you long-term holding and buying, and so does dividend investing. So the mo- to say one is better than the other, you can go look at my previous video to show that there is research to show that dividend growing and initiating companies do outperform the broad market, and also high yielding stock or dividends have been shown they can outperform the market for certain time periods. So there is research to show it's not an underperforming strategy. Both strategies preach investments in the market long term, good and bad times. So dividend investors are incentivized to keep buying when things go down because then you're getting a higher yield. So it's just semantics to me which one. The most important thing is which one can you stick to and can contribute and you don't get out of the market. So I've walked the path of the dividend because I can sustain it. I don't bat an eye. If things go red, oh well, I buy more and I get a better yield. My dividends go up every quarter on quarter, and it motivates me to keep investing, which is the only thing that matters. Um, so to this is more targeted like the people I've seen some people online. I mean, they're probably not dividend investors, but if you were thinking, well, I'll hold all my, or maybe it does, like I'll pull out of the market, go all cash, and I'll wait for this macroeconomic event to happen, and then I'll dive back in because I understand macroeconomics and with my associate degree from my community college, or whoever those people are. I'm constantly every week I have funds going and I have dividends and I redistribute them. So I'm constantly investing in the market. I'm not timing it. Um, so you can see here, this report shows the one part I want to make you understand. It boils down to really this. Um, if you just miss the 10 best days, think of how many trading days are in a year. You can do the math if you want, a few hundred. You miss the 10 best days of trading, it's going to wreck your returns. So the most important thing, you don't pull out, you don't sell your entire portfolio because you think the macroeconomic cycle looks terrible, and then you're gonna know exactly when to time it and get back in, and then you like a certain YouTuber I know tried to do that and he got wrecked by the market, and he denies it, but we all know he did it. Certain guy, but it's what it boils down to. And every once in a while you'll see there's a 700-point day in the friggin' markets, and then people online, oh, I didn't see that coming. It's like, of course nobody saw that coming. um, and you'll never will see it coming. So you have to have an investing strategy where you're constantly in the markets and you're constantly, making investments. And that's what I would say it boils down to. This was another one from Charles Schwab. So this talks about slightly different topic. They have these hypothetical people that invest over a 20-year period. So what are the rules? $2,000 they got at the beginning of the year, every year for 20 years. Right. So they're talking, 2000, 2020. You got the guy that was perfect with his timing. You got this person took simple approach. Each year she received the cash she invested on the first day of trading. So here's their January 1st. She just dumped it, the whole thing in, didn't even look at the market. Then you got this guy who divided it up across the whole year, the DCAer, the terrible timer, and then the person who chickened out and failed at life, and they stuffed the T-bills or whatever that crap is. I've never bought a bond or treasury note, so you can sue me. I don't care. Maybe when I'm like 50, I'll think about it, like a bond. So you can see the returns of these people over 20 years, right? Here's the different strategies. So this goes beyond. So the other one tells you, if you miss those 10 best days a year, you're getting wrecked. So, and this is another piece. Let's say you want to buy into the market. So now here's the different strategies. Okay, this person doesn't exist. I don't care. Anybody that tells me there's someone that does this, yeah, right. There's one guy that says he does it. Full of crap. Um, invest immediate. The one interesting part, which you probably are seeing, the person that invested on January 1st did pretty much the same as the DCAer. So again, like sometimes we argue as retail, like things that don't matter. Like I mentioned in the previous video, to mention, you're going to buy this ETF because it's got a 0.01 better expense ratio than this other one. Well, does that really matter if you like sell the whole thing when the friggin', we get a 20% down year in the markets and you panic sell? Who cares about that difference in expense ratio? So I would say the same thing here. I mean, it seems like it's semantics. Like, okay, the person that invested January 1st every year, they're getting more time in the markets to compound their returns than the guy who DCA'd, you could argue. Uh, Which one's better? I mean, again, it's like which one do you want to do personally? Because there's not much of a difference. Which one do you feel that you can sustain over long periods of time? So I mean, I would probably be a DCAer. I'll be honest. That's how my investments now. Every week I have money going to my account and it gets invested in various things. And I have the dividends that get come into my account and I pay, I invest those also. So it's just a constant churn of investments and money going in the account. So I'm never out. The bad timer though still did well. That's one thing you should understand. Even if you feel like crap, and you shouldn't feel bad if you're like say if you're just keep buying into the market. Okay, there's going to be times where your timing is terrible. Grand scheme of things, it's not that as bad as you think it is at the time. If you buy your weekly buy and then all of a sudden, the whole thing just falls apart at like lunchtime that day. And you're like, oh, if only I'd bought on Thursday instead of Friday. It's like, I mean, that's not that big a difference. I'll be honest with you. I wouldn't sweat about it. There's worse things you can do that'll wreck your performance than the bad timing there. Like we saw, you missing the 10 best days of the year will wreck your performance way more than bad timing of your buys. Um, the saying cash person, I mean, you probably all know someone like some loser that sticks their cash in their mattress, whatever. You should have cash, unlike certain YouTubers who tell you to put all your money in the market and use credit cards for a backup or some crap like that. Like, are you kidding me? Okay. So here's so this is just more background information. This is building the base of knowledge, things I find interesting. And I don't assume anybody knows this stuff because it took me a while to learn it. Um, so my next video will be either I'll go over the current state of like my invest beyond just dividend, maybe like how I've set up my finances with the goal of my goal is 55 retired on a beach. So like how am I getting there right now? I could do a brief overview of that. That's not too bad. And then after that, I will do a book review, starting my book review series. So I'm going to lay out like 5 or 6 books that I think everyone should read if you want to be a dividend investor like me. Um, so it's the first one will be One Up on Wall Street by Peter Lynch. I think every investor should read that. I don't care who you are. Every investor, that should be one of the first books you read. It's an amazing book. Just the understanding of just investing. I love that book. And then there's a sequence of 3 dividend investing books I'd want you to read um, in a specific order if you want to be a dividend growth investor. And then I'll try and recommend some books with financial statement. I'd never read a Barnes and Noble financial statement how-to book. I'm an accountant, so I have a textbook I read and went to school for. But I'm gonna try and I have a recommendation from another YouTuber I know, and I bought one myself. So I'm gonna flip through them, see if it makes sense. Um, so you have just a basic understanding at this point. I mean, I'm not a CPA, and I don't tutor accounting, so I'm not the person to teach you this very. I can teach you broad subjects of like financial statement understanding, but we can get into that later. So thank you for sticking around for was it 10 minutes here. I appreciate it. So there'll be more videos coming. If you have a comment, leave a comment underneath. And if I get enough, maybe I'll post a community tab at some point where you can ask questions. And if I get enough questions, I can do like a Q&A session if I can get enough. But there could be fun stuff like that coming. So other than that, I will see you later.
If, if you have a milkshake, and I have a milkshake, and I have a straw, there it is, that's a straw, you see, watching. And my straw reaches across the room and starts to drink your milkshake. I drink your milkshake. I drink it up!